This week at the zoo, the S&P 500 clawed its way to new all-time highs despite worrying jobs numbers. Hello and welcome back to the Wall Street Petting Zoo. I'm Christopher Smith.
And I'm Robert Coburn. The energy sector took a hit this week due to twin storms in the Gulf of Mexico, shutting down 13% of the offshore oil rigs there. The temporary dip may be a buying opportunity. There is a huge amount of insider buying activity in the energy sector right now, like by far the highest ratio of insider buying to selling that the sector has ever seen. That suggests that corporate executives are really optimistic about the future of the industry. There have been lots of production cuts, and we've seen surprisingly strong gasoline demand. So in theory, oil prices should rise for the rest of the year as the economic recovery continues. With energy stocks so cheap, this may be a sector to keep on watch.
For several weeks now, we have been watching the US dollar index, which has continued to slide. Interestingly, the dollar has remained strong against emerging markets currencies, so small countries, developing nations like China, Brazil, but it has weakened against the euro. So there's a case to be made that this move in the dollar index is really more a strengthening of the euro relative to the dollar than it is an actual weakening of the dollar. One reason that the euro is strengthening is that China and Russia are now doing a lot of their trade in euros rather than in US dollars. So international demand for euros has increased while international demand for dollars has declined. Obviously, one way to play this is to buy gold, silver, or euros, which is how a lot of people are playing it. But that trade may be a little bit played out right now. Gold and silver look a little expensive relative to the dollar. So another way to play this is to buy European index funds and US manufacturing stocks. The appreciation of the euro will make European companies' growth look a lot faster in dollar terms. So I think that we'll see a lot of US investor interest in Europe. And meanwhile, the weakness of the US dollar against the euro will make the US stock market's growth look slower in euro terms. So we'll probably see European investors leaving the US stock market. So we're probably embarking on a long period of outperformance by European stocks relative to US stocks. At the same time, though, we will see manufacturing activity move from Europe to the US because goods will be cheaper to buy in dollars than in euros. A side effect of a weak currency is a strong manufacturing sector, and vice versa. A strong currency generally causes you to have a weak manufacturing sector. We already saw the first signs of those shifts this week. Bank of America has started selling US stocks and moving money into international equities. And the PMI reports this week showed that business activity in Europe's manufacturing sector slowed down to a crawl in July, whereas business activity in the US manufacturing grew at its fastest pace in 18 months. So we should see those trends continue as long as the euro stays strong and the dollar stays weak.
In addition to the U.S. manufacturing sector, another really hot sector right now is housing. With housing prices soaring and the market desperate for inventory, this week we got data home builder confidence, which rose 6 points in August. Anything above 50 is positive sentiment. This week's read of 78 is the highest in the 35-year history of the index, and it bodes well for home builder stocks. Also this week, we got housing starts, building permits, and existing home sales data for July that absolutely crushed analysts' expectations. Housing starts grew over 22% month over month, and building permits grew nearly 19%. Mortgage delinquencies are still over 8%, and eventually those should start to weigh on the housing sector. But for now, the housing market has completely shaken them off.
Finally, let's talk about a few warning signs in the economic data. Robert just mentioned one, which is that mortgage delinquencies are quite high. Another is that the leading economic index in July increased only 1.4%, whereas the previous several months it increased 3% or more, which suggests that economic recovery will continue for the rest of the year, but it will be a lot slower probably in the back half of the year than it was for the last few months. Renewed travel bans in Europe caused a drop in travel activity there in the first week of August, pretty significant drop in travel activity, which could have some ripple effects for the U.S. economy. Although the U.S. manufacturing sector looked good on the PMI reports that we mentioned, it didn't look as good in the New York and Philadelphia manufacturing indices this week. Those are local manufacturing indexes, but they do suggest that at least in urban areas, we're seeing, continued slowdown. And finally, and most importantly, the jobs recovery faltered a bit this week. Initial jobless claims came in at 1.106 million, above both last week's 0.936 million and the consensus forecast for this week of 0.92 million. So we're seeing a degradation in the jobs market there. Continuing jobless claims improved. So we did see continuing claims drop from 15.48 million last week to 14.84 million this week. But that may just be because people's unemployment benefits are starting to expire. People are unable now to draw unemployment insurance, even though they're still unemployed. So that may not actually signal that people are getting rehired somewhere or that the jobs market is recovering. It may just mean that unemployment benefits are expiring. I'm really hoping that this turn in the jobs market was just a blip, that the recovery will resume next week. But I think what we may be seeing is that the stimulus benefits from earlier this year have started to peter out. And now we may start to feel the pain of that unless Congress gets another stimulus bill passed. And as we all know, that right now is not looking likely to happen within the next couple weeks. Let's talk stocks that we watched this week. What are you watching, Robert?
So this week I was watching Home Depot, and to my surprise, it did follow the same pattern of dipping after their quarterly earnings report, only to come back up. So as of Friday, it is still below its pre-quarterly earnings value, so I will be looking into buying into Home Depot and probably sell about a week before Thanksgiving when they announce their next quarterly earnings report, and then buy back in after it dips again. So for all those DIYers and home builders out there, keep up the good work. What were you watching last week, Chris?
Yeah, I should say that Home Depot usually does pretty well in this portion of the year as we lead up to Christmas. So probably a good time to own some Home Depot. Last week, I watched CVS, Merck, HP, and AbbVie. CVS pulled back over 2.5% on news that the state of West Virginia filed a lawsuit against it for liability in the opioid epidemic. Most of the opioid lawsuits so far have been against pharmaceutical companies, but they're now starting to target pharmacies as well. And since CVS is a pharmacy, if this case in New York sets a precedent that pharmacies can be targeted, then the cases that are open in West Virginia and Ohio could turn against CVS as well, and we could see a lot more similar lawsuits filed against CVS in the future. So it could be really bad for CVS if there's a legal precedent set that pharmacies are liable for opioid epidemic. So I'm going to be watching that really closely. And if this case in New York goes bad against CVS, then I'll be really worried about the stock for the next few years. I think we could see this be a major drag on the stock for several years. So I have definitely drawn down my CVS position quite a bit. AbbVie also had some bad opioid news this week. Their allergen division is being sued. They are a pharmaceutical company, so they are exposed to the opioid epidemic as well. But fortunately, they got some good news this week when a major competitor drug got delayed for 18 months. So they dropped slightly, but they came pretty close to breaking even for the week. My two winners for the week were HP and Merck. HP was only slightly up for the week, but it's got earnings reports coming up this Thursday. So I think it will probably rally into earnings. We'll see. And then Merck gained nearly 2% this week on a positive clinical trial result for its cancer drug Keytruda. And I'm still watching because it's got an antiviral trial for COVID-19 coming up in September. What are you watching this coming week, Robert?
So this week, well, for one, it finally happened. Bitcoin broke the 12,000 mark, but only for a small amount of time on Monday. All this time, it didn't crash back down immediately after like what happened in July of 2019, which gives it some semblance of stability. This jump over the 12,000 mark also helped move other cryptocurrencies like Ethereum. I will definitely be keeping a close eye on cryptocurrencies this week, as well as my old friend Activision Blizzard. Of course, on the heels of a great quarterly earnings report, I believe they are poised to have another great report in another 3 months, because they're actually getting close to releasing their latest World of Warcraft expansion, which definitely pumps up those monthly active user numbers. So the stock has recessed a bit since the last quarterly earnings report. So I'll be watching out this week for a time to buy back in after I cashed out in late July. What stocks will you be watching this week, Chris?
Well, I'm going to continue watching HP and Merck. I think that HP has the potential to beat earnings expectations this week because, of course, they have their 3D printing business. And with manufacturing demand heating up, I think that their 3D printing revenue could be stronger than usual. And Merck still has its clinical trial coming up for a COVID-19 antiviral in September. So I'm hoping that investor enthusiasm will continue to build around that as well. One last stock that I'm watching is Intel. Intel sold off in a big way after its last earnings report because even though it beat expectations on the report, it announced that its smaller chip, its new chip, was delayed by 12 months. So it's going to get hurt on competition in the computer chip business. But this week, it announced a $10 billion accelerated stock buyback program. So that, I think, helps compensate for some of the stiff competition that Intel is going to face this quarter. Stock buybacks generally lift the stock price. The stock price hasn't really reacted yet to the buyback announcement. It got an initial rally, but then it sold off back down to its previous level. But sentiment definitely turned more positive. I've seen lots of institutional buying activity, lots of bullish call option buying activity, and pretty significant order inflow on Intel. So I think that it's coiling for a move higher, and that's definitely one that I'm keeping a close eye on this week. All right, folks, if you heard anything on the podcast today that was useful to you, please give us a like, share, or comment on YouTube. We'd also love if you would share us on Facebook or Twitter or Instagram or whatever social media account you use. We do not do any paid advertising for the show, so your word of mouth is the only way that we get the word out there, and we really appreciate your support. If you would like to support the podcast financially, you can also look underneath the YouTube video. We've got a link to referral link to Webull, and Webull is our favorite trading platform. It's got lots of great analytics and community tools. If you've gotten tired of Robinhood and you feel like you're losing on Robinhood, try out Webull, and you may find that its analytics tools help you perform a lot better. If you sign up for Webull using our referral link, you will get a couple of free stocks on Webull, and we also will get a couple of free stocks, and that helps support the podcast. Thank you all so much for your support, and we will see you back at the zoo next week.
See ya.